Hello everyone, Mark here again at TSLA, and as you can see on the screen, unfortunately Tesla closed slightly in the red. The closing price was $274.43 a share, and the percentage of that would be a negative 0.76%. There was a slight uptick in the after hours. I believe it went up maybe 50 cents. I don't have the exact number on me right now, but it wasn't a sell-off in the after hours, which is number one, nice. Number two, kind of telling to what this price action will be. We'll dive into that and kind of explain what happened after we get to some really brief news. So let's transition over to that news. The Mercedes-Benz adopts Tesla's NACS, the first German automaker to do so. Hint, hint, Volkswagen, where are you? Anyways, so looking at the Electrek article, it's basically following the same format the other OEM manufacturers have done, which is going to be taking I'm putting the NACS port on their model year 2025. All the other cars sold until then are going to have adapters provided. Mercedes wanted to also let people know they're still going to move forward with their own brand of high power chargers across North America, which will be placed at strategic positions on highways to kind of facilitate long distance travel. They're teaming up with ChargePoint to do that still. It's just that they're going to have the NACS plugin as an option as well. Other than that, this is not much else to talk about. It's just that it wasn't a catalyst to keep the stock from falling today. And it wasn't really a catalyst to boost the stock up during the pre-market action. Of course, everything kind of fell onto the jobs report that came out today, which is the more important one. Looking at the CNBC article, we're talking about the non-farm payrolls. Non-farm payrolls increased 209,000 in June over the previous month in May. The estimate or consensus estimate for all analysts was 240,000 jobs added in June. So this, of course, number one, is a large difference in jobs added month over month compared to that of the ADP payroll report, which came out yesterday. And if you don't really keep track of non-farm payrolls, this is one of the first misses in expectation for the job creation, I want to say, in over a year. So this is a really big deal. I don't think we've missed. I'm sorry. I don't think we've guessed higher on the actual since maybe April of 2022. And so that in itself is really telling, because to miss on the jobs report, you kind of have to process that. Okay, so we had the ADP that's higher than consensus. We had the payroll, non-farm payroll, which is lower than consensus. And like I spoke about yesterday, they have two different ways that they figure out this number and they calculate the number, with ADP being tracking of specific companies. But those specific companies, of course, are not every company in America, and they constitute about 25 million jobs across America. That still leaves another 90 to 100 million jobs that are not accounted for or are not tracked, because it could be there is a large portion of small businesses that are responsible for hiring and keeping people employed in this country. And non-farm payrolls is a survey, so they contact people and kind of ask, like, how did the business do with hiring and firing, et cetera, et cetera. This is kind of a big deal, because this might be the first sign that the labor market from one of these economic readings is cooling down. But what's not really cooling down is, of course, unemployment rate is still very, very low, and actually down 0.1% from the previous, which was at 3.7. Now it's back to 3.6. And the wages actually rose higher than what people thought by a couple basis points. So wage growth in itself contributes to inflation. You might have heard something called the wage spiral inflation or something like that. Essentially, that's a byproduct of having a lot of power in the hands of workers like ourselves, who have job mobility, that we can find jobs or demand higher pay from the current job because we will leave to find another job. But as we saw yesterday, job openings are kind of contracting. So as job openings contract and less job openings are out there, you don't have the same mobility just to move around and get any job you want to. So I'm curious to see how this wage growth is going to slow down or not slow down over the next couple months. But it is wage growth is important for the Fed. They want to see wage growth come down. I know that sounds terrible. You got to wonder if the Fed ever just spoke in plain speak on a national television station during primetime evening hours and said the stuff that they say during FOMC meeting press conferences. I wonder how people would take that information. They would be basically saying to the general populace, you make too much money. We need you to get fired. We need the unemployment rate to go up. So we will have then evidence that our monetary policy changes are working and cooling down the economy. I'm like, how do you even say that? And then how do you balance that? How do you reconcile the fact there's two responsibilities for the Fed? One is maximizing employment. And number two, of course, is containing that inflation. So very curious, very curious. But yes, so having a cooler jobs report led to a kind of a jump in the pre-market trading and slow buying throughout the day, to the point where the NASDAQ closed its gap and the S&P 500 was barely there. And some of the tickers didn't really do so well with that either, like Tesla didn't close the gap. So let's take a look at this real quick. Is there any information that we need to know here? Okay. This is actually really important. So CNBC's article goes and say the total, while still solid from a historical perspective, meaning that adding 200,000 jobs in a month is so much better than what it could be, which would be negative job growth over the month, or even just like flat over month over month. The previous 2 months actually had revised job numbers. So you probably remember in May's number that it was very, very high, 300 something thousand. It was actually revised down considerably. And so that's actually, we actually are not making as many jobs as we think we're making, because every time we come out with a new report, we're revising the numbers down for previous months. So actually for the last 2 months, we've actually lost, we still gained jobs, though we didn't gain as many jobs. Another thing we want to make mention of is how a lot of the jobs that are being created in the non-farm payroll report are government jobs. So like what 1/4 of all jobs created in the last month were in the government, and that's either like I say, state or local levels of government. But this is not private industry creating jobs. So they kind of broke down like where a lot of the job gain was, which was healthcare, social assistance, and construction. This is really interesting. I highlighted this because when I read over this article, I was like, I don't get it. Because as you know, in the ADP payroll report from yesterday, leisure was one of the biggest contributions to that 497,000 job number. But as you can see in the non-farm payroll report, it was just only around 21,000 jobs. Now, the seasonality, it might be calculated different. I really do believe that ADP, their calculation is definitely skewed to make the administration look better, perhaps, because it doesn't really make sense that the growth of the jobs in these two different reports are so different. But regardless of that, it is what it is. A strategist at Principal Asset Management went on to say a 209,000 increase in payrolls can hardly be described as weak. It's just really weak in regards to consensus, only because consensus is always lost out to actual for the past year. But let's head over to the charts and talk about how Tesla and the overall market did, considering the payroll report and the other news. So we'll switch back to the chart. We'll have Tesla up front. Now, as you can see, the trend line did not hold, so we can go ahead and delete the diagonal. It did not hold. It almost did. But this is the daily. As you can see, we're still above in the gap. We're not really closing the gap yet. Hopefully we don't have to close this gap. Some gaps have been left open. So as you can see here, we still have a gap over here. We still have a gap over here. So we didn't close those. We don't necessarily need to close them. In the future, maybe they'll get closed. Hopefully not ever. Hopefully we never see these prices ever again. But let's go down to the minute. And we can also turn on, oh, well, we don't need to because we see the gap up. So it was a nice open, right? Like we opened up, you got into the gap from the previous day, and unfortunately we went to sell off and found a base kind of in this kind of area of interest for a lot of people, this 275 area. And it got bought back up, and the rest of the market did as well. And it kind of just made this kind of like cup shape, inverted cup shape, and closed at the low of the day, unfortunately. Now, you have to ask yourself, like, why is this? So why, really, if you really look at the chart over the past week, since the gap up on Monday, this is kind of where people are at. And this is the lowest that you're trying to get. And they're, as you can tell, they're trying to keep it low as possible. They're trying to keep it very low. And there's a reason for this, and it's because of the week. The week, number one, is shortened tremendously because Monday, it was a half day. Tuesday was a holiday, and he had 3 very low volume days. There wasn't a great amount of participation. Even like Wednesday and Thursday were just desperately bad when it came to volume for most stickers. And so all this selling basically is because when all the big money went on vacation, you probably noticed on Friday of last week, it wasn't very active either. And it was because a lot of people already mentally checked out. They're going on vacation, they're going to the Hamptons with their kids, or they're going to Europe or Disney World or something like that. And so when you're away from your desk for a while, what do? Well, you're not going to sell all your positions because it's not really what happened. What they did was they just wanted to be delta neutral over the course of the week plus a day. And that's what you're seeing here. They didn't want big movements in stocks. And of course, you couldn't help it with Tesla. They did the best they can by keeping it flat and keeping it as low as possible day after day after day. But when people are out of the office and they're doing other things and like living their personal life, they don't want to have to worry about their portfolio, their trading portfolio, or whatever money they're managing. So they create a very delta neutral position, which is essentially they don't want to have big fluctuations in the values of their stocks. So basically they put on options as maybe hedges to maximize the value of a portfolio that barely moves. So how do you make a portfolio that barely moves? And this could be them selling theta, this can be selling options and stuff like that to even net a premium. But they don't want big fluctuations in price because they're not there to watch it. They just want to get through the week with as little effort and thought as possible. So as simple as this: when there's big movements in stocks, they're going to bring it down to the mean or the average as much as they can. Let's take a look at the last 4 trading days. It's basically the same price as it was on the close of Thursday of last week. Like, it's almost like we didn't go anywhere. And that's kind of the whole point. They didn't want to go anywhere. The market makers, or the big money and all the fun people, they wanted just to get through the week and make sure that their positions are as flat as possible when they're gone. So let's say they leave on Thursday, they're taking an early vacation, they're out Friday, flying to the Hamptons. They want to be sure when they come back on this coming Monday, which is, I believe, the July 10th, that the stocks didn't change. Mission accomplished. They went nowhere. It's really like what's the difference here? 0.05%? It went nowhere. And they did exactly what they did. So what would happen? So stocks went up, and so they have a bunch of options that might have expired today. What are they going to do? They need to be delta neutral. They are selling all the things they need to get down to flat price. And so this would have been, if let's say, for example, like it was a bad Monday and it sold off a lot. Well, by the end of this week, you better believe that it would have been bought up and flat. So it's kind of expected. You'll see this through like maybe sometime in August when a lot of the people that work on Wall Street take a last vacation before their kids go back to school, and you'll see volume drop off. You'll see very, very flat, rangy trading. It's brutal, and it's really just for people who are selling premium, selling options. Like if you would have sold options last week, a big expensive option on your shares, you would have had a great week. You could just coast. You didn't have to do anything because you would know that the market makers are going to sell it off for you. So you don't have to lose your shares. You don't have to pay out. You don't have to do anything. And this is vacation trading, essentially. Set it and forget it vacation trading. So that's what happened. But let's take a look at Tesla again. And we're still respecting the gap. We still have a couple gaps. We have a gap, the big gap here, and of course we have a gap from last week. So we're not really threatening to fill them. It's just that the market really wanted to stay as neutral as possible. Now, what does that mean for next week? Next week is going to be so close to earnings. I really think, and let's zoom back out to a larger time frame, and I always talk about the range. I really don't think we're going to break out of the range. There's just no catalyst to do it. So let's say you're actively trading. And I always said the range is going to be on the top of this September high of last year to, maybe our gap. And it would be something like this. So I'm going to draw the box. It's going to be to the top of the gap. Sorry, from top of the range to the bottom of the gap. And we'll end the box on the date of the earnings. So let's take a look at this. Let's move the price out of the box. So as you can see, we haven't, I always thought it would be around 289 as a max. And so far we're there. And so what does this mean for you? I would say, and this is not financial advice, but this is what I'm doing. If I'm long Tesla via options, and of course I'm long, everyone's long here via shares, but if I'm long Tesla via options, I don't want, number one, I don't want to be expiring by next Friday. I just don't see a catalyst other than some breaking news like Cybertruck is going to be released, or the Model 3 is assembly line is finished and people are seeing them roll off this assembly line floor in Shanghai. And I'd be like, okay, that's nice sentiment. What we thought is happening sooner than what we would have figured, which would be, Cybertruck later on the end of the quarter, maybe Model 3 being delivered by the end of the year. But if we start seeing something moving much faster in that respect, cool. I'll be all for breaking out of a range. I'll be all for rallying really hard, but it's likely not going to happen. So what do you do for this week? Well, you want to sell premium if you want to be playing options. Like if you have shares, you can sell cover calls against your shares, but that's not real financial advice. It's something that I have done. I actually, as you know, have a call sold against 100 lots of shares. And what I actually did today is I closed it out in the middle of the day, and I sold a more expensive one at around, I think it was 279 or 278. It wasn't at the high of the day, but it was relatively up there. And I just sold it for a more expensive July 21st expiring option. So basically, I moved the strike down to collect more premium because it's more closer towards the actual price. And it's still expiring on the 21st. It's more premium. And what I want to do is on Monday, maybe buy a call as a hedge with some of that premium. But as well, I kind of want to have, I kind of don't want to be carrying options into the weekend. So the type of options you want to carry into a weekend is really just selling options. Selling puts or selling calls is more ideal than carrying options into 2.5 days of theta destruction. And considering that if you, once again, believe that we are ranging, that, we're really not going to see a breakout of the range, then holding onto these options in the near term is kind of pointless. Now, if you are wanting to play options, it's really about buying yourself time. Buying yourself time to get over the earnings hump and get maybe a little bit past earnings so you don't have to experience too much volatility and you have time to recover. Now, let's be honest, the earnings for Tesla have not been always great. Let's take a look. So we have an earnings here in the April last quarter. Did not turn out great. We had a gap down. These are just rough percentages, but maybe a gap down of 7.5%. Here's earnings from earlier on in the year. Did okay. Yeah, not too bad. Let's say it's 10%. How about these earnings here? Flat. So the earnings in October of last year, small gap down, but ended up flat over the course of a week. But it opened pretty low. It opened down almost 10%. How about this? Earnings here. This earnings was decent, and it opened up slightly with a slight gap up. Let's say 3+%. How about earnings here in April of 22? and it gapped up nicely and then proceeded to sell off tremendously. So it was 11% gap up. And then by the time, if you want to just measure from the day of the earnings, over the course of, let's just say, 5 trading days, it was already down 7% from the day before earnings, and the total down from the gap up was 16%. And how about earnings from January 22? Not so great either. I don't see a gap, ironically, but looks like it sold off. So earnings aren't necessarily that great. Here's a decent gap up. Not even a gap up, but just a regular up, around 4%. So as you can see, number one, the moves are not big as you might expect, but they are considerable considering that, a lot of the times people lost a lot of money. And it's almost not even worth playing the options because, number one, these moves are, let's say, 4% to like plus 4% or to minus like 7.5%. These are all moves within expected volatility, expected movement, expected range of results of the stock's reaction to the report. So likely, if you have options expiring the week of, meaning the 21st, even if you had call options, there's really not really good signs that you're going to get a 20% move, which would be required almost to actually net any money. So what happens is after there is an event, and most events that people watch are quarterly report events. And so before a quarterly report is released, you'll see call options and puts and all options start appreciating value, even though the underlying stock is not really moving that much. It's because what's happening is volatility of the stock is being anticipated. And so people want to collect more premium on their options because they're at risk of having to pay out or, have their shares called away. So that as an event approaches or something happens unexpectedly, volatility would increase and thus the option prices will increase as well. This is great for selling options because if you're selling options when IV is increasing, you're getting, of course, more premium. And you're getting more premium for the possible risk of losing your stock or having to pay out a lot of money. So saying that, still though, we talked about a couple report movements, and they range, like I said, from plus 4% to to negative 7.5% to negative 10%. But if you are holding an option expiring on the 21st and you don't get a move of over most likely 15%, you're not going to see really an appreciable result in your in profit in your options at all. Most likely, the IV that will quote unquote crush, meaning IV will contract after the event is over. So because there is no implied unknown anymore. It's just we know what happened. The premium of all these options will just disappear. So if you want to play earnings, what you want to do is buy yourself time for earnings to play out, because the further you get away from this earnings date, you will actually, of course, experience less volatility and less crazy IV contraction in your options. Buying yourself time, if you want to play options, buy yourself time and kind of as much as a person can afford, get options that are as close to the money as possible and as further dated in your mind and from your own experience and research as to a time frame that would help the stock play out its move, and not have enough time and your option expires before the move is fully realized. Another way to play earnings is to actually buy the shares, and when IV starts expanding, sell call against it. Or if there's a lot of red days preceding in earnings, you could sell a put that would be a little bit more premium than what you're actually used to receiving for that stock. So there's different ways to play it. When you get closer and closer to earnings, let's say the week after next, as there's less time after the earnings, you can You could possibly on the Wednesday before close, buy some quote unquote, and this is not financial advice, this is something I might do as just another type of cheap hedge for upside risk, is you can buy options that are expiring that week. And if you buy them the day before if you buy them the day of their earnings report, because they're going to report after hours, you can buy, let's say you buy it on that Wednesday, they'll be the cheapest they can be, right? Essentially. And you don't want to have to buy a option that expires on the 21st this coming Monday and then see the value just get destroyed with theta loss because the stock ranges for a week and a half before the earnings report. So that's something to think about. I would be really careful when it comes to playing options against Tesla's earnings, because the movement sometimes just isn't there for the expected range that the market is thinking of. When the market determines like their expected move, the options within that range, whatever percentage up and down from the current price, like if you don't get a move outside of that range, like you're not going to make any money and you'll lose a lot of money. And do your own research and look at the results of Tesla's price action after earnings reports. Is it really enough to move 10 to 15% in the course of one day or 2 days that you might have? It's highly unlikely. Could it happen? Yeah. And how could it happen? How can Tesla's stock move up or down in a big way? So to move up, you need to see gross margins somewhere near 20% or higher. To move down, you'll see gross margins less than 18%. And then you'll see some type of, you probably want to look at the CapEx, like I mentioned in the previous video, and see how their cash position is. And if they have it at the release of the earnings report, it could be that next day or that very night where they apply or they file a report with the SEC that they want to raise funds, capital, somehow, some way, via, I don't know, maybe they're going to issue bonds. Maybe they're going to sell shares or create shares or sell a different type of share or something like that. That would drop the stock considerably. Is maybe some insider sales shares as well that might be reported by earnings could be pretty telling. But whenever you see these insider sales, just be sure you understand what you're seeing. It's not sometimes people, oh my God, our stock price is so high, I need to sell. Like if Zachary, when he was selling shares recently, it's because, he's just selling a couple $1 million for the shares because he's trying to provide for his lifestyle. That's it. Not to mention, some of these are all planned because they know their expenses and during a course of a year, maybe they need to pay taxes, but they're going to sell shares to just basically to get by. They're not doing it because they're fearing that the stock price will go down. Let's just be serious. We're looking at the 1 hour time frame right now. Let's just go to a daily on the time frame of Tesla. Are we really that high? Are we like NVIDIA directors who are selling shares when they're valued at around $420, which is well over their all-time high? No, Tesla's really, really low. I mean, if Tesla was trading at $440 or something like that, and then you were seeing a bunch of directors sell shares, okay, maybe you should take note of that. Maybe they feel they've topped out. But even NVIDIA still went on to go even higher from after the shares of, I know they were selling anywhere from $395 and to $415. So just looking at the big picture, there is still room to go upwards. But is that room really there for us to capture with this tough macro environment, with higher interest rates and people needing to buy cars with loans? Like how are they getting money to buy these cars? Is this all cash purchases? Are people actually financing at anywhere from like 7 to 25% to buy a new car? We're really not sure. But if rates do come down, you better believe that Tesla is going to be a big winner of such an economic condition. Now let's take a look at some other parts of the market. Yields are creeping back up. So this is from Friday, and it's pushing up against 4.07, which is really, really high. And this is in contrast to the dollar index. So typically when you see the dollar index, and as you see, it's very red. Typically, when you would see stocks sell off, you would see the dollar index appreciate in value. You would see it go up in value as people are selling equity to go into cash for safety. But now that, so this is going to be helpful to understand what happened today, this week, and what might happen next week, is that you're looking at a dollar index is very, very red that sold off even though stocks were selling off. And when stocks sold off, it did not really go up very much. Now, this could mean that people are not fleeing to safety, quote unquote. There wasn't really any sector rotation. There wasn't really any type of flight to safety because yields weren't going down. On like if you were fleeing from stocks, maybe you buy bonds, right? But if bonds are not being bought and yields are still going up, they're not really doing anything. They're not selling out of fear. And you can explain this move by simply saying, okay, we know the yen is being vastly manipulated, right? It was at 144, I want to say a couple days ago, and now it's at, I believe, 142. So that's some type of intervention that the Japanese government is doing to bring down the yen. And so why does that matter for DXY? Well, DXY is made up of the yen and some European currencies. Like a value of a currency has no value unless you compare it to something else. And in case of DXY, the dollar is compared to a basket of European currencies and the yen. So if the yen is getting stronger, the dollar could get weaker. And this is what happened. So even though there's a sell-off in equity, even though the yields are going up, the dollar went down because the yen manipulation by the government. But what it also means is that maybe you can see further weakening in the dollar. Maybe the dollar gets weaker, and that means, what does that mean? So if the dollar gets weaker, then we're not going to have the same dollar problems that you hear about in quarterly reports. You probably hear something along the lines of like, oh, this is our earnings on a constant currency basis, or we're facing currency headwinds because the dollar is so strong, making other currencies weaker. So let's say you're a multinational company like Tesla or Apple or Microsoft, and you have consumer bases outside of America, and they're trying to buy something with their local currency that is made by an American company who does business in dollars or even manufactures in America or what have you, and then you bring that weak currency back into America. I mean, you're losing out. You're losing money because their currency is so weak and the dollar is so strong. But if you can see this dollar continue to get lower by whatever manipulation it is, be it stronger economies in foreign countries or manipulation in people's currency, possibly Japan and China, that you will see the dollar come down, and that would be a tailwind for a lot of multinational, international companies who no longer have to worry about the dollar being so strong. And it is much stronger than, it's much weaker than what it used to be, obviously, as you see here. So we could see these benefits coming through reports in the next 2 or 3 quarters. We would like to see that. But that's all for today, guys. Thanks so much for listening. And I'll have another video out this weekend. I think I'll review some news over the past week and just kind of compile Tesla in a week. Thanks so much and have a good night.